market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Global stocks set a new record with AI and renewed hopes of a Middle East deal lifting optimism. We'll discuss all of that and more in just a second, but let's start with SpaceX, which is under pressure this morning after it disclosed higher than expected spending on its AI business. That's, of course, dampened a debut quarterly report that broadly surpassed Wall Street forecasts. Now, the chief executive, Elon Musk, also outlined plans to significantly accelerate AI development.
We expect the cadence of AI development to improve dramatically. And then with Grok 5, which should be out before the end of this year, we will be incorporating the entire corpus of SpaceX data, basically all the data that SpaceX has ever produced, which is a tremendous amount over the course of a quarter century, will be incorporated into Grok training.
Well, let's get more with Beata Manthey, head of European equity strategy at Citi, and Neil Campling, our senior strategist. So thank you both for joining us. Neil, let's just start off with the fact that SpaceX was better than expected, but it's very clear investors are freaking out because of this AI spending, and it was the same about Meta.
Yes, and to put it simply, rockets burn fuel, SpaceX burns cash. Not even on profits, but on revenues. For every $1 of revenue it generates, it's burning $2 of cash. And this is the problem. To meet the ambitions that it has in the hopes of getting to $1 trillion of revenue by 2030, as Musk mentioned last night, is going to require significant investment. And that, at the end of the day, the company is also spending far less than the hyperscalers on trying to create a hyperscale footprint. That's a problem. I think investors see straight through that issue on the cash flow line.
I mean, you know, we've been trying to get through earnings for tech in general. We'll talk about tech, and then I want to see the broader, markets, Beata. But, Neil, AMD is also pre-market kind of getting slammed. And, is there something that we should worry about AI, or is it just the concerns about valuations and too much spending that is coming home to roost?
The questions on the spending will resurface the questions on those returns. But AMD, it's also a question of expectations and a bit of travel and arrive in the stocks. They've just printed a 50% year-on-year revenue growth number, which is a very high number. The problem is expectations were higher. So the guidance is actually a little underwhelming compared to where the street were at. And also AMD is the 6th biggest points contributor to the S&P gains this year. So that puts in context, I think, where the stock has been and where it's got to into the print.
Beata, what's your take on earnings so far?
So it's been a pretty decent reporting season, right? In Europe, it's been an average reporting season. In the US, already one of the better ones, but that's, of course, skewed by a few companies beating the expectations hugely. But what is interesting is really Europe, because this is the poster child of the broadening, if it indeed is happening. So the average reporting season, 57% of companies beating expectations, dollar amount beat 3%, nothing spectacular. However, when you look at composition of the growth we are reporting on, so 15% up earnings growth this quarter year on year, pretty good. It was 11% expected a few months ago, but the composition is entirely coming from positive from all of the sectors. It is the first time that is happening since 2022. So that's a good thing.
But why is that? Because, there are questions about the fact that Europe could be left behind when it comes to AI adoption on a number of things. So is it cost cutting when you look at earnings overall? And if it's across industries, what are we seeing? Because it's not the strength of the economy. It can't be.
Absolutely. So it's the economy is improving, right? Citi economic surprise indices are really shooting up. That's a good lead on what's to happen. So that also tells you that, well, the economists maybe they haven't overcut the forecasts if the risks through the Middle East persisted. But if they stop, you have upside surprises there. That's good for earnings, right? So one is domestic story. Let's not forget we have this big fiscal stimulus happening in Europe. Investors have forgotten about that, but it's happening. A bit of that is coming from the currency as well. The biggest share is coming through tech, still through commodities, and financials, industrials are contributing a lot. But the fact that there is almost no sector contributing negatively, that tells you the broadening is happening, and hopefully better times ahead.
And Beata, this is not productivity gains through AI yet, right? We haven't really seen, we're just at the beginning.
You don't really see it in the numbers yet, but if you listen to what the companies, European companies, have been saying through this reporting season, there are more meaningful, tangible facts that they are reporting that these gains are happening across. Not on the aggregate number, you won't see it, but you have bits and bobs happening. And also, when you look at the performance of the adoption, so we have a basket of adopters in Europe, it started to meaningfully outperform as well. So there is a bit more to that.
And Neil, going back, I mean, one of the things that were shocking in the last couple of weeks actually is these security breaches. OpenAI and Anthropic AI agents, now we understand, have been implicated in new security breaches. So what more do we know about that?
Yeah, this is coming around from the detailed testing that's going on in these environments, and these tools are so sophisticated that they are also able to capture where there are problems in the coding that haven't been detected for many years. So what's great about the models is capturing these shortfalls and these flaws. What's bad about the models, of course, is if they get into the hands of the bad actors. So we're still learning about some of these models, and so just like with your iPhones, when you get these security patches that come through in updates, we're getting updates on these as well. So we're still waiting to see more detail, but it's both a risk, certainly, but also, and that's actually good for some of the software companies that are providing the fixes into these models.
Okay, thank you both. Neil Campling there, and Beata, of course, stays with us. We'll talk a little bit more about the earnings season. But now to the Middle East, and the U.S. and Iran are closing in on an interim agreement to reopen the Strait of Hormuz. Now, President Trump says Iran talks are going well, and the waterway will open very soon.
I think it'd be very smart to make a deal. We'll see what happens. They had a very good day. The negotiations were good.
Well, for more, let's bring in Abir Abu Omar in Dubai. Abir, so what do we know about this possible Hormuz deal?
Good morning, Francine. Well, we know exactly that. We know that the deal is about the Strait of Hormuz. Now, just bear in mind that this is not the same deal that was signed in Switzerland, that MOU with 14 concessions that was supposed to get the talks between the United States and Iran starting. This is a deal primarily to get the Strait of Hormuz reopened. Axios earlier in the morning reporting a few things about the mechanisms of this deal, Francine, saying that inbound vessels would use a northern lane near Iran, and then outbound vessels would use a part of the strait that is in the southern part of it, or closest to Oman. It would be for 60 days. No tolls or fees would be charged, and then it would open up the trickle of movement in the Strait of Hormuz. As you have mentioned, President Trump saying that it could be imminent. Other U.S. officials telling us that it could be signed as soon as today. Now, just something to bear in mind that one of the key mediators in all of this, Qatar, saying that nothing has been finalized. It was working on a draft language to present to both Iran and the United States. Both, as of now, according to our understanding, are reviewing it. But it is exactly that. It is the Strait of Hormuz that is front and focused right now for both sides of the table that are keeping the blockade on the Strait of Hormuz. Francine, the U.S. maintains the naval blockade. Iran maintains the threat of attacking ships that are going through the waterway without seeking permission or sticking to routes that it hadn't laid out for them. So we wait and see if, in fact, the deal is as imminent as today, as President Trump had alluded to earlier.
So, Abir, what would a Hormuz deal today actually mean for the fighting and for the Iran nuclear program?
Yeah, that's a good question. And it's pretty premature to tell what it means for the fighting now. Remember, the Switzerland deal, the MOU that was signed in June, it lasted for about a month before the fighting commenced or recommenced in the region. So what we understand from this deal is that it's not meant to tackle those wider concessions or those wider agreements that President Trump and Iran had come to in June. What it's meant to tackle is primarily the Strait of Hormuz and just getting those energy flows back to the table. And then something else that we're also seeing, Francine, is that Brent crude had dipped below the $80 on the barrel as of early hours of our morning. But the escalations that are happening in the Red Sea have pointed to an uptick in oil prices just about an hour ago. And so that is something else that Saudi Arabia, which has resorted to the Red Sea over the past month or so, or over the course of the war, will have to pay attention to. And so that is something else we're keeping an eye on. But when it comes to the wider fighting in the region and the parallel aggressions that have been happening between Saudi Arabia and the Houthis and the militia in the southern part of Iraq and Saudi Arabia, those are things that we'll probably not see addressed for the time being. Everyone's concern for the time being is just getting that movement that has been paralyzed over the past 3 weeks or so, just getting it restarted again in the very vital waterway.
Abir, thanks so much. Abir Abu Omar there with the very latest on the Middle East. Now, still with us, Beata Manthey from Citi. Beata, I mean, again, the market is moving on hope of a kind of deal. Unclear whether we get it. It's 2 steps forwards, sometimes 1 step backwards. Does it actually help with inflation in Europe?
Well, that's a good question. Absolutely, it should, right? So one of the big risks that is still hanging over the markets is the hawkishness of the central banks. So that's definitely a risk, and the deal really takes the risk of the ECB hiking going forward. It takes it away, which should be constructive for equities, and especially European equities or broader cyclical equities.
Beata, overall, I mean, given the earnings season that we just talked about, what do European companies need now? I mean, what do you need actually to be overweight in some of them compared to other parts of the world?
So we are quite encouraged by this broadening. We are encouraged by what the analysts are doing with their earnings revisions. So European earnings revisions, I was actually quite surprised, I have to say. They are almost at all-time highs now, coming from broad set 80% of sectors being upgraded, and they've been upgrading even in pre-reporting season that tends to be a very negative, has a negative seasonality. So all of these tell me that from the fundamentals perspective, the setup is there for Europe to outperform, right? From the macroeconomic perspective, you have the setup. I've mentioned Citi economic surprise indices. They are improving if the Middle East risks are contained. And the hawkishness, as you just asked me, if inflation is contained, that's also a positive. So the setup is there. Yeah. So all we need is geopolitics. Geopolitics is that we've hedged these hopes, everything I'm describing from macro and fundamentals perspective. I feel like I'm having a déjà vu from almost every year that we are going in the right direction, and then something happens, and it gets put on hold. But this is happening. Europe, of course, it's going to be a very crucial year going forward for Europe, because we are negotiating the next 7-year budget on the European Union level. Yeah. So that's going to be a very important thing to watch, because there'll be changes there in how money is invested, right?
And what could go wrong? I mean, again, you have quite a lot of politics, right? You have France going to elections, probably elections in Italy. In the UK, we have a new prime minister, unclear what he'll do, for example, with bank taxes. So there's a lot of unknowns. I don't know whether it's more domestic issues that you worry about this year compared to also, these geopolitical shocks that could really come from anywhere.
So that's a good one. Perhaps at the start of the year, we were more worried about the external shocks. Now, of course, it's a balance between the two, because external shocks are still there. But as you say, next year is like a huge year for elections in Europe. So we start with France probably in May. So it's going to be something to watch out for sure. And there could be disappointments, but our view is that Europe is on the right path, and it is more united and realizes what needs to be done to boost growth and prosperity going forward. So
I know earnings were good across the board. Is there an industry that looks really set to benefit from the big trends and divergences that we'll see in the next couple of quarters?
So Europe is an interesting index because it doesn't have that much direct exposure to AI. So tech is only 10%, right? But if the broadening happens, so it's a mixture of Europe getting its act together, the infrastructure spend continuing, while at the same time global build-out of AI, where European companies feed into, continues as well, then for us it's basic resources, industrials, and second-order effect positive, it's banks. So it's pretty cyclical.
It is quite cyclical, especially, I mean, when you look at commodities and some of, how do you expect that? I mean, a lot of the demand has to come from China. And actually, I don't know how much of a reading we need, a clear reading on China to see the strength of European companies that we keep on saying, well, they don't need to choose between the US and China, but actually at some point they need to grow towards one or the other more.
Of course. So Europe, again, 50% of revenues in Europe come domestically, and there are, for me, fewer question marks on the direction it's going, because the money is flowing there, right? The fiscal is there. But we've been quite bearish on the impact of Chinese. So whether it's European exports to China, we've had a negative factor on our allocation model on that. So, for example, we are still underweight autos. We've been for a very long time, and we are still underweight luxury consumer products, which perhaps there are some signs that they are turning, right? But overall, that's been a very negative factor, and a lot of bad news has been already priced into the exporters, and especially exporters into China.
Beata, thank you so much. Beata Manthey, their head of EMEA equity strategy at Citi, stays with us. Coming up, we'll also speak to the Novo Nordisk chief executive after the pharmaceuticals giant actually reported results. That's coming up next, and this is Bloomberg.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience. Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Welcome back, everyone. We're having a great conversation on some of the earnings reports. We talked about oil, and of course we talked about tech in general with Beata Manthey, who was also saying she was a little bit surprised by the strength, actually, not only of the European economy, some of the indicators, but also some of the earnings that we saw. So we're back with Beata Manthey, head of EMEA equity strategy at Citi. Beata, when you look at the future for Europe, actually, and a lot of these companies, where does healthcare sit in all of this?
So healthcare is a very idiosyncratic sector where, of course, what happens with the drugs and innovation influences it a lot. But what we've noticed, so this is one of our preferred defensive hedges. So we do see, even though we are very pro-cyclical, we do see that in this point of the cycle, volatility will persist. And healthcare has its place as this defensive hedge, and also it's an anti-AI hedge. Yes, AI adoption will happen there through time, but it's been a very uncorrelated trade. This is why recently it's been doing very well and serving as this hedge.
When you look overall at portfolio construction, I mean, do you have to hedge almost naturally with industries more than in the past, given, a lot of the sector overweight of AI in general?
So we have been for most of this year, I have to say, but recently we've taken a bit, so the healthcare is the last hedge that we have there. You need to have something because AI volatility is going to be there. The biggest question is what are you going to do with tech? So we think you stay invested, but it is ever evolving thing. So you need to be, it's really stock pickers market when it comes to AI. It's not going away, but you need to diversify. And Europe, actually, because it doesn't have as much tech, comes out as one of the biggest winners in terms of investors choosing the regions for diversification.
Beata, thank you so much for joining us. Beata Manthey, their head of EMEA equity strategy at Citi. Now, Novo Nordisk has raised its forecast for the second time this year on a rosy outlook for its obesity and diabetes drugs. But sales of its new Wegovy weight loss pill have failed to top analyst expectations. Well, we're now joined by Mike Doustdar, the chief executive of Novo Nordisk. Mike Doustdar, thank you so much for joining us. I know you extended some of the discounts for some of the lower doses of the Wegovy pill and pen. Would you be open to discounting more? Does this, have you extended and will extend the discount?
Thanks very much for having me. I think that the pill launch has shown itself to be
much better than we had expected it, and I would say pretty much most analysts had expected it, because we had set the price at the right level. We are matching, I would say, a phenomenal volume uptake at a decent price where we can turn this into good profitability, and I'm very excited about that. So at this point, I would say we are not right now discussing further discounts. You have to remember that today in US, from every 10 patients that are needing a GLP-1 pill and seeking one, 9 is coming for Novo Nordisk and 1 is going to our competitor. So we're in a good spot.
So you don't, I mean, there's worries or concerns or I guess question marks, whatever you want to say, from analysts about your long-term competitiveness. And you say these are wrong. This is what you're telling me, that actually this is just the start and you'll go after market share from Lilly.
I think we've done well, and the analysts are expecting even more when you do that. But I would say that this is, we had a situation where we came to the pill. We had the best pill launch in the history of medicine, and that was, of course, welcomed. But a lot of analysts were skeptical. What will happen when our competitor will launch their product? I can tell you that it took us 12, weeks to get to 1 million prescriptions. This final million prescriptions, now adding to 5 million that we have, took us only 4 weeks, in spite the fact that our competitor not only is in the market, but is trying very hard to, of course, capture their own fair share of prescriptions. As I mentioned, we have right now close to 90% market share in the pill segments. So we are incredibly proud and happy of this. Our job, of course, to continue what we are doing and go forward. But the pill is doing the job for us to a large extent as well. It's the most efficacious pill with 17% weight loss, a very good tolerability profile, and it's easy to take. We don't have to worry about all the other medications you're on when you take our pill. So it seems like that the physicians and the patients have made their choice, and I'm very happy about that.
You've also said that Novo may look into more consumer-focused products, and potentially, I guess, in aesthetics or longevity. What does that look like? Is there a plan for this to, increase? Is it direct-to-consumer products? What's your thinking on all of this?
The way I look at it is that we need to follow the science. One of the things that we have come to learn and the world has come to see is that many of these incretins, GLP-1 as an example, they do multiple benefits rather than just weight reduction. We understand this science better than anyone else because we got into this business a number of decades ago. So we need to take that scientific knowledge that we have and match it with the purpose and the passion we have for the patients and the consumers and try and find the best match possible. When we do, not only it could be a good business, it's also irresponsible not to address an unmet need. So that's what I have said, that I will not rule out us getting into other areas that the science is taking us to.
It's been reported that AstraZeneca is exploring acquiring Bristol Myers Squibb. Do you think the age of the mega deals in pharma is back?
I cannot judge on my peers and what their rationale is. What I can tell you is that when we look at business development, I do not think about the number or the magnitude of the deals to start with. I look at scientific and strategic gaps that we may have and how we can fulfill those. What we have concluded so far is that on one hand, Novo Nordisk has a phenomenal pipeline and a lot of R&D knowledge. But we also have concluded that we don't have a monopoly on the best ideas. So we are right now looking at bolt-on acquisitions to try and complement our own assets and see basically how we can serve the world in a better way.
Where do you see a potentially transformational deal for Novo?
At this point, I don't see that actually, because we don't have a transformational gap that I'm trying to fulfill. I actually think we're in a very good spot as we are now. We're basically looking into a number of assets that can complement what we already have, and that's what we are doing. Looking into bolt-on acquisitions is right now where my focus is. But I've also said that I am not a person who starts with a no. So if one day the answer should be a transformational deal, then one day we'll look into that. But that day is not today.
When you look at that day is not today, that's very clear. If you look at the different parts of the business, is there one specifically that you want to boost?
I would say when I look at our obesity pipeline, we really have a phenomenal pipeline. We are addressing most of the patient needs right now in either late-stage assets or some of the early-stage assets that right now I'm not able to share with you. I feel comfortable, albeit we are continuing to bolster on that. On the diabetes front, we are a little bit more challenged, and our, of course, intention is to really stabilize and strengthen our diabetes business that we are still a leader of, and then move into some of the adjacencies that our patients are asking us to do. So that's a little bit in a nutshell our strategy right now.
I know you've had another clinical trial setback last week with the failure of the heart trial for Zeus. I mean, analysts worry that your pipeline is just not strong enough once Ozempic and Wegovy go full generic. What's your response to that?
I would say that one single asset does not define our strategy. We've been very vocal that we would continue our strategy and expand our assets into cardiovascular area. We have early assets. We have some also still late stage assets that we are, of course, looking into, as well as, of course, it's an area where we will be more active looking into business development and see how, again, we can look outside of our own shops. But CV is an associated area to obesity and diabetes, and it's an area that's very strategic for us to strengthen and develop further on, despite the setback with Zeus trial.
Mike, just a final question going back to the pill. Do you expect profitability on the pill to improve in the course of the year?
As people, of course, are titrating into the higher dosage of the pill, there is no secret that the price of the higher dosage are higher. So that, of course, improves the profitability even for the single patient that's on the pill, today. As we are, of course, also going forward, we continue to create efficiencies in our manufacturing sites and in our cost structure. That is also improving it. In general, I would say the profitability of the pill is decent and will continue to get better. If that was not the case, we would not be launching the product in more and more markets. We have just announced, of course, that we will continue post UK and UAE our launch into Germany and more to come. So that is, of course, on the back of, seeing the top and the bottom line of the pill, performance.
Mike Doustdar, thank you so much for your time and conversation today. That was the Novo Nordisk chief executive joining us on the back of results. Now, disruptions on one of Europe's most important trade arteries are poised to intensify after the Rhine fell to the lowest on record ahead of the peak summer dry season. If levels get enough to halt traffic, then it could cut off a critical oil waterway. Well, the Rhine stretches from the Swiss Alps to the North Sea, linking Switzerland, Germany, France, and the Netherlands. Well, let's discuss all of this and the potential impact with Javier Blas, a Bloomberg opinion columnist. Javier, I'm disappointed you don't have a map with you, but away from that, I mean, we've already lost 3 major waterways because of geopolitics. If you cut off the Rhine, I mean, how much of a disaster is that?
It's pretty bad. I mean, we saw in 2018, that is the last time that we were as low as we are right now. Actually, we are lower now. That could have an impact even on, to be noticed, on the German GDP. Economists estimate that in 2018, the German GDP growth was shaped by about 0.4%. We have production halts in chemical plants across the Rhine, steel, refineries, coal-fired power stations. So the impact can be quite notable. The industry learned the lesson in 2018. It's better prepared today. They have bypass alternatives, although a critical bypass that has been used in the past is the Rhine Bank railway is under renovation, so that's not usable. But so I think that perhaps it's not going to be as bad as 2018, as long as it rains very soon.
Okay, but what if it doesn't rain very soon?
Well, it doesn't rain soon, and sadly the forecast is not for much rain for the next 10 days at least. We are going to start seeing companies like BASF, a big chemical company, announcing that they need to cut production. Already in the last earnings conference call, the chief executive suggested that some force majeure means that effectively cancellation of contracts may be needed in the short term if the rains don't come.
Javier, are there any measures being put in place now?
Yes.
To ship more quickly?
One of the measures is that the industry post-2018 decided to, in the Rhine, let's just kind of zoom back a bit, in the Rhine, what we use are barges, and those barges need a certain amount of water. The industry designed a new kind of barge that is designed to navigate with very low water levels, as low as today. Those are still continuing going through the river, but they need to carry a lot less cargo than before. In normal circumstances, they can carry 5,000 tons. Right now, they're only carrying 800. That's having an impact. Everyone is using these new barges, but they have a limit, and we are reaching those limits. If those limits are reached, what we are going to see is that we're going to see a move to use more railway and using more trucks. But bear in mind, for every barge that we cannot sail through the Rhine, we need 100 trucks.
Wow, that's really quite impressive. And the scale of it is actually hugely and really immense. Javier, talk to me about inventories because of what's happening in the oil markets and the Middle East. Like, we're closer to a deal. We've said that before. It hasn't really happened, so who knows what happens geopolitically. But how long does it take for some of these inventories to be replenished once the Strait of Hormuz fully reopens?
Well, it will take a number of weeks and months in some cases to rebuild all the inventories. We may be rebuilding inventories all through 2027. But if the Strait of Hormuz reopens and the oil flows, we have seen in the past when the Memorandum of Understanding was reached about a month and a half ago that a lot of oil will come into the market. The market probably will move into a surplus, and that will over time rebuild inventories naturally. So prices don't need to stay high until the inventories are replenished. The prices could trend lower. And to be honest, if you look where the market is today, Brent around $80 a barrel, WTI around $75 a barrel. That's about, we'll say, on the high end of what I will call a normal price. The global economy has had that in the past with no problem whatsoever.
But Javier, this for me is the most surprising, right? We went into the war with a lot of, the famous analysts saying, like, this is going to be a crunch. We have to stop flying maybe in August because of concerns of jet fuel as well. Like, is it because the economy has absorbed it much better, or how do you, like, prices have been high but not through the roof like certain people expected?
I think that there have been several elements. One is that we still look at oil shocks through the lens of 1973-74, and the global economy has changed a lot since then. But on this particular one, we used the strategic petroleum reserves very early on the crisis. In previous crises of supply, we have waited months. You look at 1990, 1991, we took 6 months to release the SPR after Saddam Hussein invaded Kuwait. Here, we took action within 10 days. Of the war starting. That was very important. The other two important measures is that there were some bypass capacity around the Strait of Hormuz via pipeline that was used. A lot of oil was leaking through the Strait of Hormuz, going dark in tankers. And the most important factor, I think, is that China surprised us, taking a huge step back from the market. China used to buy, before the war, around 11 to 12 million barrels a day of crude on the seaborne oil market by tanker. It bought in June only 5.5 million barrels a day, a 50% reduction. And that China taking a step back has had a huge impact onto the market. We know what China did. It's still a bit unclear how they are doing it, whether it's a combination of their own reserves, that the economy is more flexible, perhaps their economic growth is lower than we thought, and therefore the oil demand is not growing as much. There are a number of elements we don't really, or at least I don't really understand how China did what they have done, but what is clear is that they took a massive step back from the market.
And when you look at, so let's say we don't have a deal between the U.S. and Iran, what happens to these? How many more inventories do we have? How much more?
We have some inventories to go for long. I mean, it depends on how much of the bypass are in use, how much leakage still occurs, and crucially, how much oil China needs to buy in the next few months. I do think that China can continue buying what they were buying in July, and they are buying so far in August, which is significantly less than they were doing pre-war, probably 35% less. Not as a deep contraction as it was in June, but still a significant one. I think that they can do that for perhaps until the end of the year. If that's the case, we have inventories to go until the end of the year. But every day that the Strait of Hormuz remains closed, we are draining a bit the inventories, and at some point that needs to stop.
I mean, do you think this war will change how we think of energy security in Europe?
Oh, yeah. I think that it will change how we think of energy security across the world. I think that it's going to be a push to rely more on your own energy. For some countries, there's going to be a push for more renewables, because that's what they can do at home, buy solar panels, install it and run it. For some countries, it's going to be producing more oil in their own territories, so drill more. And for some, it's going to be relying more on coal. But there have also been a huge, significant, to me, trade and diplomatic awakening in this crisis. If you look at the relationship between some G7 members and the United States, Japan bought a third of his oil in June from the United States. From the United States. If you have asked me that question 20 years ago and say Japan will buy a third of his oil from the US, it will have things like science fiction. Europe is buying 65% of his LNG from the United States. And also, so the US is crucial energy supplier for allies in Europe and in Asia. And also at a time when Europe is concerned about the dominance of China in supply chains, as we have been discussing, if we are not at the $200 oil, it's in part because what China has done. So at a time where Europe is trying to reduce reliance on China, we are realizing that actually, de facto, we are even more reliant for our economic well-being on what China is doing.
So interesting. Javier, as always, thank you so much for joining us. That's Javier Blas from Bloomberg Opinion. I read all of Javier's columns, and also he has a great book. A couple of years, actually, now, but I still think it's very, very relevant, The World for Sale. Bloomberg has learned that Chanel's sales rose strongly in the first half of the year, outperforming rivals including LVMH, helped by strong demand for Matthieu Blazy's new collections. Now, we're told comparable revenue at the private company climbed about 16%, with similar growth at the company's fashion division. Well, let's get more from our Bloomberg luxury reporter, Angelina Rasquet, who's in Paris for us. So, Angelina, first of all, what's driving sales growth?
Hi there, Francine. I mean, as you said, the results for Chanel in the first half were very strong. Overall comparable revenue rose 16%, and that was actually the same at the fashion division. The fashion division is the biggest unit of Chanel. It generates about 60% of sales. And basically, Chanel enjoyed the benefits of the new creations by the new designer, Matthieu Blazy. He was appointed in December 2024. He made his first collections. He unveiled his first collections last year, and they were commercialized from March this year. And actually, they've proven to be very popular with customers in an otherwise relatively morose market. So what's interesting is that Chanel saw really strong growth in all divisions. So it was the case for fashion, but it was soft leather goods, but it was also the case for watches and fine jewelry. That division grew by more than 30%, and helped by lines like Coco Crush, but also the watch segment grew, which is a segment that has been struggling in the past couple of quarters. And otherwise, beauty and perfume was also growing. And when it comes to geographical breakdown, all the regions grew, including China, including the Middle East, but it was led by the US, up more than 25%.
I mean, in terms of the sectors, or actually the items that are driving the most, how are shoes doing?
Shoes are doing fine. As we saw, there's this list that's made by a company called List, which tracks all the hot products online. And in the first quarter, Chanel was the hottest brand, and they cited in particular pumps that came out that cost 1,300 euros. But actually, if you look at Chanel, I mean, the bags are doing relatively well. Chanel was one of the brands that really increased massively prices in the post-pandemic, and recently with the new collections, they introduced new bags that are in the price range that are considered to be slightly more affordable. So that's, let's say, below 10,000 euros a bag. But if you also look, I mean, the fine jewelry division did really well, and that's because customers are really keen to purchase products that they think are going to keep their value in the long term, and that's something we also saw at Richemont. Richemont, the owner of Cartier and Van Cleef, in the last quarter, overall sales rose more than by about 20%, and that's definitely something that we're seeing. It's the strength of what we call the hard luxury segment, basically jewelry and gold pieces that are seeing that are very popular with consumers.
Angelina, thank you so much for joining us. Angelina Resquet there on the very latest from the luxury sector and Chanel in particular. Now, coming up, OpenAI and Anthropic safety tests finds models carrying out more so-called unsanctioned actions. We'll have the details next, and this is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The labour market backdrop still pretty decent.
When you take a look at wages, when you take a look at the JOLTS data today and the quits rate, that's going to matter.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labour market seems okay.
We don't see any wage pressures in the economy.
We're all building up to one thing.
The July Jobs Report, Friday on Bloomberg.
Infineon has forecast quarterly revenue that beat analyst estimates. The German chip maker benefiting from rising data center chip demand and price increases. Well, Bloomberg's Anna Edwards asked the chief financial officer, Sven Schneider, how investors will react to that guidance.
On the back of a record quarter Q3 in terms of revenue, we're expecting a steep, much stronger than seasonal final quarter. We expect a growth of 13% quarter over quarter and 19% year over year to 4.7 billion. And we expect as a follow-up of that, of course, a very strong follow through in the margin trend. So 400 basis points up to 23%. And that then, as you said, brings us to a full year guidance, which is, especially in terms of the revenue, probably slightly ahead of expectations. So I would summarize it as we are exiting the year on a very, very strong path, and it's a broader based recovery which stands behind the numbers. So it's AI driven, clearly, as the number one growth driver, but there is more than that. For example, also a very strong momentum in the automotive industry.
Yes, and I'll come to that in just a moment, Sven. Can I ask you about the power chips segment? How important is the power chip segment to you in your growth story? You describe it this morning as the most important growth driver. So how big can that become?
Yeah, and indeed, I think our CEO said it a couple of months ago, I think very well. It is the biggest growth driver in the history of Infineon. The magnitude of the business, to put into perspective, is give or take 10% of our group revenues this year in AI data center, so more than 1.6 billion, doubling from last year. On top of that, there is 500 million of non-AI related data center business, business. So it's more than 2 if you add it together. And we expect a very steep growth. For us, it's powering AI from grid to core, including the power infrastructure. And we have already given a guidance, which is pretty rare, for the next year, which stands at 2.5 billion plus as AI data center revenues.
Well, that was the Infineon CFO, Sven Schneider. Now, artificial intelligence models developed by OpenAI and Anthropic carried out potentially harmful activity during safety testing, including trying to inject harmful code into software. Now, the UK's AI Security Institute said it was the first time it had seen risks around autonomy and deception manifest so clearly in the real world. So let's get more from Parmi Olsen from Bloomberg Opinion. Parmi, thank you so much for joining us. Parmi's my go-to person every time I have a question on AI. Can you actually break down for me, like, the potential security risks posed by these AI agents?
Yeah, so first of all, I think it's important to remember this was conducted during a testing phase. So it wasn't as though these chatbots or any of the chatbots regular people use are going to break out of their systems and wreak havoc on the internet. But as you were saying in your summary there, when they were tested by the UK's AI Security Institute, which is a government-run agency, these systems, which are the newest systems from Anthropic and OpenAI, it was mostly Anthropic's model that did this, showed signs of trying to deceive people in order to get information or put through malicious code. And the deception part was the most interesting part because they weren't designed to do that. They needed to get an objective, and in order to do it, the models tried to trick a human reviewer on another website or another company to approve this malicious code, and the human actually noticed that there was something dodgy going on and said no. Now, in terms of should we be worried, I think we can be concerned, but we don't have to be massively alarmed just yet. As I say, this happened during testing, so and the safeguards that are normally put into these models to stop them hacking had been deliberately removed. So it's a little bit like when car manufacturers test the cars with crash test dummies, they are going to take out the safety brakes so the car, will crash into a wall, and this is the same kind of thing, just to kind of see what could potentially happen. The other thing is that actually, if you talk to people in cybersecurity, some people are not too worried about AI behind the scenes. They don't want to say that publicly because that's not great for their business. But AI's models, when they hack, they're not stealthy. They're actually quite noisy, and they're very easy to detect, which is why when OpenAI's models hacked Hugging Face a few weeks ago, that was found out within 2 days. There were something like 17,000 different actions that took place in terms of traffic on the network. These instances were also immediately found out. So it's a little bit like in hacking, in real life hacking with humans, you're going to try to be like the burglar that goes around the back and tries to find that window that you can sort of unlock. But in this case, the AI it's like going through the front door in broad daylight and banging it down. So that is the one reassuring thing that we can think about right now, is that they're very easy to detect. And also, again, this was taking place in testing conditions. Yeah. So I think it's important to put pressure on these companies to ensure that these systems are really well contained, particularly when they're testing them. But right now, I don't think we need to worry about, if you're a company or a consumer, that they're going to kind of do anything harmful to you. But,
I mean, can they be contained even if they're bad actors using them? So either state-sponsored hacking or bad people?
Well, if it's a bad actor who wants to use a model for hacking, they can't if it's Mythos or a proprietary model from OpenAI or Anthropic, because they've got really strong safeguards. In fact, when Hugging Face was hacked by OpenAI, they couldn't even use a high-quality model from OpenAI or Anthropic because it was stopping them. It thought they were trying to hack somebody to defend themselves. So if people are going to use these systems for hacking, they might use an open source tool. But even then, I've been talking to people in cybersecurity who say that cyber criminals, ransomware criminals, and gangs, they don't like necessarily using these tools because they hallucinate. They're not necessarily trustworthy. All the kinds of issues that we have in offices and in certain professions, seeing a lot of parallel concerns in the world of the dark web and cyber criminals.
And I mean, there are also various iterations, right, of these models. So will they change? Do they patch up? Do they fix themselves as we get along?
So I think as these models become more capable, the companies that make them are putting in very, very strict rules to stop them from being used for hacking. I think the bigger concern might be around open source models, which don't necessarily have those kinds of safeguards in place and can be more easily manipulated. But you do need, if you're a cyber criminal and you want to use an open source model, that's going to be costly for you. You need to get all the kind of potential compute that you need. You need to get very talented engineers who know how to use these systems. And sometimes that trade-off just isn't worth it.
Parmi, I mean, moving to big tech earnings, what have we learned so far?
So we had earnings from most big tech players now over the last week or two, with Google kind of kicking things off a couple weeks ago. And I think one of the big takeaways is these companies are still spending huge amounts on AI. Like it or not, investors are kind of being dragged kicking and screaming into this new world. The four biggest AI spenders are Meta, Alphabet, Amazon, and Microsoft, and they're spending something like $740 billion. They're putting that towards AI capex just this year. That's up 80% from last year, so it's not slowing down.
The numbers are so big.
I know, it's insane. It's like, what is money? So I think right now investors are just, you know, they're. In terms of, you looked at the shares, of course, Microsoft was up as soon as they announced their earnings. Meta was down something like 10%.
Meta, is it because should they go after AI? This is not the first time, or do they just stick to their knitting?
I think Mark Zuckerberg sees that he has to bring his company to a new chapter in order to keep growing, to maintain dominance. And he tried doing that with the metaverse, and it just didn't work out. Now he is pinning his hopes on artificial intelligence, and in my view, it actually looks more plausible than anything he ever laid out for the metaverse. Now, notwithstanding the fact his shares fell at the earnings, I mean, that's because Microsoft can show an immediate profit for their spend. Meta, it's all sort of hopes and plans.
Parmi, thank you so much. As always, so interesting. Parmi Olsen from Bloomberg Opinion. Up next, Bloomberg Brief. And this is Bloomberg.